Hello class, welcome to chapter 3. Today we're going to be talking about property and about claims to that property. In accounting, the purpose is really to provide information about the property and the financial claims to that property. So a couple terms we have to understand is one, what is property? Property is anything of value that a person or a business owns. So either you individually or something that a business owns. The way that we determine whether or not something has value is if you could sell it and receive cash for it. So if you had something that you could sell for $100, we would say that it has $100 in value. If you had something that you could sell for $500, we would say it has $500 in value. So whatever it is that you own, the value is determined by, if you were to go and sell it, what we call liquidating it, it'll tell you how much value that it has. The next thing is the financial claim to it. That's the legal right to it. So if you were to actually go and sell that property for $100 or for $500, whoever has a claim to it, that determines who would get the money that was given for the sale of that item. A financial claim is basically when you go and sell the property, who's going to receive the cash? Whoever has the financial claim to it, those are the ones that are going to receive the cash when you go and liquidate or sell your assets or your property. Okay? So let's look at some more terms here. A creditor lends you money and you buy something on credit. So the first thing we're going to look at is the term credit. Credit is when you buy something and agree to pay for it later. You guys hear credit all the time in credit cards and other types of things, right? If you were to go into a bank and borrow money, you're basically being allowed credit. You're getting money or you're buying something and you're going to pay for it later. You would pay the bank back the money later. Or if you would go into a store and you would buy something and tell them, I'm not going to pay for it right now, I'm going to pay for it later, that would be an example of using credit to buy something. You're buying something now, but you're not giving them the cash for it. You're going to pay them back later. What we call those people that you owe the money to is a creditor. Okay? A creditor is any person or business to which you owe money to. So if you went into the bank to get a loan for a car or for a house, they would be your creditor. They're the person that you owe the money back to. If you were to go into a store and not pay them right at that point, if you owed them the money, they would be considered your creditor. So credit is buying something and paying for it later. The creditor is the person that you owe the money to for what you just purchased or what you just bought. The next part here is we're going to look at financial claims, okay? And also different types of assets. So assets, you hear me use that term, right? An asset is simply the property, the thing of value that is owned by a business. So the difference between property and assets, anybody can own property. You personally can have property, you can have a house, you can have a car, you can have jewelry, you can have lots of things. That's property. But when a business owns something of value, when the business owns property, we consider that to be an asset. So when the business buys something that has value, that can be resold and cash can be given for it, we consider that to be an asset. So here's some examples of some of those. We have land. If you have land for your business, you could sell that land and somebody will pay you money for it, that's an asset. Cash. Cash is the best asset to have. You don't have to sell it to get the value out, right? It's already there. Cash is an asset. Office equipment. Office equipment, anything, computers, printers, things you have around your office that help you do your work, those are assets. If you were to sell your business tomorrow, you could sell your copier, your computers, and all those things and get cash for them. Manufacturing equipment, say you have a computer company where you make computers, right? All the equipment you have, or a car manufacturer, all the equipment that you have to make that, the items that you're selling, those are considered to be manufacturing equipment, and yes, you could of course sell them in order to get cash. Buildings and other things. So these are just examples of assets, things that the business owns that have value, and if they wanted to, could be sold and cash could be received for them. Alright, equity. So now we're talking about the things of value and who actually has equity in them, or who is the one who would get the cash if you were to go ahead and sell it. So let's look at the first definition. We have equity. The accounting term that's used for the financial claim to the asset. Whose equity? You guys hear about home. Now we're going to take a look at an example of an asset that's being purchased where you owe money on it, and we're going to take a look at the financial claims to that asset if we were to sell it. So in this example, we have a bike lock. The property is the bike lock, and the bike lock is valued at $100. Remember, we give value to something based on how much we can sell it for. So right now, we have a bike lock worth $100. So we have a couple choices, right? We can either go and we can pay $100 of our own money, and we could buy the bike lock. Now, if we were to sell the bike lock in that case, guess what? We would get the full $100. But if we didn't have $100, we could possibly go and borrow the money. Remember the creditor? We could borrow the money from somebody and they can come up with the rest to buy the lock. So if you look at the example on the board, we have property that's valued at $100, okay? We were able to come up with $60, so we're short how much? We're short $40. So in order for us to buy this bike lock, we need to borrow $40. So we went to the bank, we told them we needed a bike lock, they lent us the $40, and there you go. We went into the store, we had our $60, we came in with the $40 that the bank gave us, and we were able to walk out of the store with the bike lock. Well, guess what? We don't really like riding bikes anymore. Now it's time for us to go ahead and sell our bike lock. So we go on Craigslist or wherever we go to sell our bike lock, and we do it, and somebody says, yeah, I'll buy it for $100. So they come and they pay us back, and they give us $100. We come, we exchange, I buy a bike lock, we got $100. Do we get to keep that full $100? No, right? It's not really our $100 to keep, because there are two people who have claimed to that $100 bike lock, or the value of that $100 bike lock, right? We put in $60, so if we were to sell it for $100, we get to get back our $60. That's our claim. But remember, who do we owe the $40 to? We owe the $40 to the bank, because that's what we borrowed to them. So do they have a claim to that $100 that we just sold our bike lock for? Absolutely, right? So what we would do is we would take the 100, we'd give 40 back to the bank, and we would take our 60 back. Now both of the people, the parties that had claims to that asset, have been paid back, and that's the way that it works. All right.